Well, good afternoon. Glad you could hang in here with us to talk about PPP, forgiveness after flexibility. Then other things continually change, and we're here to help keep up on top of it with you. So more things have changed in the short amount of time than anything I've ever experienced in my career. And so we're going to talk about a few things here. So we're going to talk about the PPP flexibility. The Flexibility Act passed in June, so we've got some new changes there. They've updated the loan forgiveness application. There's a new EZ form also. Pardon me. There's also some more changes that may be on the horizon, and as always, we'll take care of your questions. And I want to take care of the first question first. For those of you that were here last time we did this, the number one question I'm getting is, what happened to the bird? So there was a bird that crashed into the window during the middle of our presentation last time. I'm happy to report that the bird did survive the accident. So the nice thing is it was not found nowhere along the building, so that's a good thing. So with that, we'll get forward here and go forward. So this area is continually changing. Remember, this program didn't even exist 3 months ago. 3 months ago, it was still making its way through Congress. And in this 3 months, we've gone from nothing to something that has funded over $500 billion in loans and has helped millions of new borrowers. So yes, we want to know more. We wish there was more out there, but keep in mind things are continually evolving. This is based upon the rules that have been issued through the 23rd, and there's a lot more expected. So stay tuned as we continually help you make through these changing times. So as these changes, what's really going on, and some of these changes, if you go back to the original rules we had when you applied for loans, the amount you could apply for has kind of evolved over time depending upon what rules were out there at the time. And if your loan amount would change based upon the new guidance, either up or down, you just follow the rules when you made your application. So if your application was made properly, there's no issues. If it meant you got extra dollars, well, then you got extra dollars. If it meant under the new rules, you could have got more, so you should be able to get more. I'm sorry, you're only allowed one application at a time. So you're only allowed one application, so you can't get more dollars currently. But as we're talking at the back, there might be another chance down the road. So what's the thing, why did I put this up here up front? Expect similar rules for the forgiveness applications too. So think about that. We're only allowed one loan application. So it's likely we might be only allowed one application for forgiveness. That's not written anywhere yet. I haven't seen anything like that, but just keep that in mind as we go through the process. So the PPP Flexibility Act, which was the potential change we talked about last time, is now a reality. And there's a few things that are in it. The covered period now is extended to 24 weeks. And non-payroll costs can now be 40% of the forgivable amount versus 25% under the prior guidance we had. When you look at safe harbors for FTEs, we're going to look out to December 31st rather than June 30th. And note that at this time, December 31st is the date. June 30th is not an option in this choice anymore. That's also December 31st is the day we'll look back to for some of the safe harbors for bringing people's salaries back to to levels that they were in the past. The loan maturity is extended to 5 years for new loans. Notice the word new. If you applied before June 5th, your loan term stays at 2 years, unless you and your banker can agree that you'd like to move it out to 5. I'm sure all the bankers would love to have additional long-term 1% interest loans on their books, wouldn't they? So, you know, our goal, of course, is to get forgiveness. So hopefully that this loan maturity won't have as much of an impact. The loan deferment period is now extended. Remember, the initial deferment was for 6 months. So in other words, for most people, that was to allow time to get everything square. Well, now it is. It's based upon the date that the forgiveness amount is determined. So you get a year after that. So pardon me, it's you look to when your covered period ends, and you get a year past, and you get a year after your covered period. So it has really been pushed out quite a bit here. Keep in mind that the allowable loan did not change. So yes, they're talking about 24 weeks. Well, but when you apply, you only get 2.5 months of payroll. The application form did change. It was very minor. It just had to do with who was allowed to apply versus the amount that you can apply for. So if you look at the forgiveness application itself, really, this is the revised form, and probably some of the bigger things that you're going to see. We'll talk about, notice that you're looking at the 60% number down here. That's the biggest change on page 1. So on the the forgiveness form itself, we're going to, you get the same type stuff we had in the prior one. So you're going to need the name, address, etc., PPP loan number. You have to, if you had an EIDL loan, you're going to need that, and application numbers. When they're talking about employees, just as a reminder, remember, you need employees at the time of the loan application and employees at the time of the forgiveness application. Remember, those are employee numbers. Those aren't full-time equivalents. So the way we're telling people is you should count anyone who worked in that period of time, even if it's just an hour, they're an employee. So it's not full-time equivalents, it is employees. It doesn't fit anywhere, it's more for their demographics. The big deal here is the default covered period is now 24 weeks from the day the first proceeds are received. So if your first proceeds were received Monday, April 20th, you have until October 4th, Sunday, October 4th, to be able, is your covered period. If you got your loan prior to June 5th, you can choose to use an 8-week period. And if you did that, then that same loan where the proceeds were received April 20th, you're looking out to Sunday, June 14th. So quite a long period of time, quite a lot going on. Basically, if you cut to the chase, what are they saying? They're saying, please spend the money appropriately, and we want all these loans forgiven. That's really what it's coming down to. The alternative payroll covered period, it's really designed to make payroll reporting easier, and it's for really your administrative convenience. So if you pay your employees biweekly or more frequently, you may elect to use the period that begins the first day of the first pay period beginning after the PPP loan disbursement date. And if you elect to use this option, you're going to use this option for all sections where there's a reference to a covered period or the alternative payroll covered period. In other words, it's all payroll calculations. You're going to do things consistently. You just pick one choice and use it for all of them, versus picking and choosing using different things at different times. If there's not a reference to the alternative payroll covered period, you can't use that. And that's really the things that where you're not going to see that reference. That's going to be your mortgage interest, rent, and utilities. So I left this slide in because I've actually have changed it. It says, what if I have multiple pay frequencies? So if you have some monthly and twice monthly frequency people, maybe you've got some of your office staff maybe on a monthly frequency, but the majority of your people are on a bi-weekly period. Does that prohibit you from using the alternate payroll covered period? In the latest guidance that came out from the SBA, it held that it said if you have a bi-weekly or more frequent period, you can use the alternate period. It did not say that because you have a period that is not that prohibits you from using it. So therefore, based upon the way this guidance is written, I would use the opinion that you can use this alternate payroll covered period as if you have some biweekly or weekly period people, because especially with the new forgiveness, think about it, we're getting so much more time to use it. They're saying effectively, we know you're going to use the money, so let's let you align your periods to count FTEs on a much easier basis. Because if you're looking at a monthly pay period, you're always going to have some bifurcated reporting periods, so it'll make it a little tough. So they're saying, well, let's just make part of your job easier. So this is a change from what I've presented in the past. So they still have the rule that it is you get all the expenses paid during the appropriate period and those incurred in the appropriate period as long as they're paid soon thereafter. That's the English version. So the soon thereafter is on the next regular, for payroll, the next regular payment day. For utilities, it's the next regular billing day. So you're going to just make sure you can't count the same expense twice. I got a kick out of it that they made sure that they put this in the guidance, that you can't count the same expense twice. As if you pay something that was incurred, you don't get to count it either paid or incurred, not both. By using this process of paid and incurred, you are this is gonna allow you to do a little bit of planning if you want to use a little shorter period. So payments within the covered period are allowed, even if they're prepaid. The only thing you can't prepay is your bank interest. You can pay some, if you have some interest that's in arrears, you might be behind. Yes, you can use that, but you can't pay ahead and call that interest. That's the only thing that you're specifically not allowed to prepay. But for those of you that heard me speak before, I'm a strong believer in the pigs and hogs. That pigs get fat and hogs get slaughtered. So you really want to be reasonable. We've talked to some people that were looking, when we were talking about an 8-week period, could they prepay 4 months rent? Well, Todd, it's paid. I said, yeah, it's paid. But remember, a human being is going to look at this. You have to work with your banker, and the SBA is allowing this flexibility because they're saying it's going to have de minimis impact. If you push a lot, that's not really de minimis. But now with the extended period, it's really not as big of an issue. But by using paid and incurred that blend together, realistically, you're going to get more eligible expenses. If you look at payroll, right, you're always going to have your 8 weeks that are paid in that period of time, or 24 weeks in that period of time. But you'll also get the time that is incurred and paid later. So you'll always will get more. You'll never get less. So there are some new, these are the certifications. There's not a whole lot of new things in here, other than notice that here the payroll costs are now at the 60% level, so that's all throughout. Notice that 60%, whether it's 8 weeks or 24. Compensation levels we'll talk about. It's one of the queries we had. What did you use? Is it, or are they going to leave it at 15,385? Well, for owners, it's 20,833, but for individuals, for non-owners, it is really, it's a little over $46,000. Now there's 3 times 15,385. So there's some different numbers we'll talk about, but they are allowing you more than just the 15,385. When they talk about some of the new, we'll get to some of the new safe harbors that are in there. But there's nothing, no surprises I really noted. So now we're back to our friend Schedule A. So what Schedule A is, we're calculating what is allowed payroll. Quite honestly, what is allowed payroll? So when you submit your application for forgiveness, what it's going to be is the 2-page application that's there. It's also going to be Schedule A. It's not the worksheets that are referred to. You need those, but you don't submit them with. And what's different here, there's some new safe harbors. And then they're talking about, there's some little check boxes on whether or not you've met some of these. This is a new one here, just saying if nothing's really, if your total employment is the same or higher, just mark here. We're not going to make you do all the other work. So I want to spend a little bit of time on these employee allocations again. This really didn't, other than the dollar amounts, because of the extended periods, things didn't really change here. But remember, your deal is that the really difference between Table 1 and Table 2 is Table 1 employees are the only ones where you have to worry about a salary or wage reduction calculation. Table 2, there's no risk with that. So Table 2 are your higher earner employees. So they're more worried about the rank and file employees and whether or not they had their wages reduced. So let's look at some of the details here. So again, you want as few people as possible in Table 1. In Table 1, you do not include the owners. You do not include anybody who made over $100,000 in 2019. You don't include anyone who received a bonus or commission that would annualize to over $100,000 in 2019. So if you had a biweekly payroll, one payroll of $3,850 would annualize to over $100,000. So if they got a year-end bonus of $4,000, that employee, technically as drafted, you wouldn't have to include those people in Table 1. They'd move to Table 2, maybe all told, they they made $80,000. It would still be excluded from that from table 1. But for owner employees, there's a little tighter payroll cap. So if you had 8 weeks, didn't change, right? Employee by employee, it's $15,385. For owner employees, the cap is $20,833. Pardon me. That is 2.5 months of wages. Even though you're using a 24-week period, which is about 5 months, you're only allowed 2.5 months. And the reason that they're allowing this shorter period of time just for owner employees is they don't want the owner employee to be able to get forgiveness on their own wages for more than they originally applied for. So there was a $100,000 cap when you went in, and based on $100,000, you got 2.5 months, and that's what we're going to cap it at, because that's really the amount of the loan you got. They don't want to have an owner get more forgiveness just because of their own wage. So the other tighter cap, remember too, is that if you had a down year for compensation in 2019, and maybe you made a lower amount in 2019, or you had earned a bonus in 2019 but was actually paid in 2020, you are basing your cap for owners on the lower of what you was paid. The $20,833 or $15,385 cap, depending upon what period we're using, or the applicable payroll compensation for 2019, 850 seconds or 1050 seconds. So it's the lower of those 3 numbers. So you can't just give a bonus to an owner to get additional forgiveness. If you hadn't in the past. Partners and sole proprietors, nothing's really changed in this particular slide. Just keep in mind that with the 24-week period, if you have a Schedule C earner and they have no employees, so the only thing you really applied for was based upon the wage substitute for Schedule C, congratulations, I'll guarantee you'll get full loan forgiveness, because you'll be allowed 2.5 times the monthly amount from the 2019. That will work. You always look back at 2019, and that's what you will get. For K1, you're going to look at 2019. Also, partners in a partnership, you back off half the self-employment tax. That's why you multiply it by 0.9235. No, you don't look back to what your half the self-employment tax was. You multiply by that factor. For Schedule C earners, congratulations, you don't have to make that modification. Why did I leave this? Just a reminder what is included in the payroll costs. Nothing's really changed there. So just kind of keep in mind. So for employees, you can use cost paid plus payroll cost paid and incurred. You're capped at $46,154 for the 24-week period, which is just 3 times the $15,385. The owners, you're capped at $20,833, as long as 2019's limits wouldn't cap it even further. The payroll costs that are excluded, same stuff as we've had in the past. So nothing really really changing there. So when we look back here, you put people in the right classifications, add it through the employee identifier, just so you know, just remember that's the last 4 digits of the Social Security number, as a reminder. So then we have our reference periods. The reference periods did not change even with flexibility. The reference periods did not change. So you're still going to pick the lowest number is between 2/15 to 6/30/2019 or 1/1/20 to 2/29/20. For most of my clients, I haven't found one yet that is not using the 1/1/20 to 2/29/20, which makes things a little easier. And owners are not included in the FTE counts. So you're going to look at, when you look at the FTE calculations, nothing's changed in this. So you have a choice. You're going to look at hours per week, divide by 40, and you're on to the nearest tenth. But the maximum for any individual employee is capped at 1. So if someone works 50 hours a week, they're 1. If someone works 38 hours a week, they could be a point under this test. They'd be you'd probably end up rounding it up to 1. It could be 0.95, right? But if you're down at 36, it's going to be a 0.9. Choice 2, it's if someone's full-time, working 40 hours or more, they're 1. Anyone else is 0.5, whether they work 10 hours a week or 36, they're a half. Your choice, whatever you want to do, whatever makes your testing easier, whatever gets you to the best result, your choice. And based upon the extended period for the payroll use, I could see more people moving to the 0.5 because, as we'll get to in the examples, the extended payroll period, the FTEs are not as important. It's just when you pick a period, you have to pick a method, the 10th method or the 0.5 method. You have to use the same one for testing your reference period to the covered period you're going to use. When you're going to look at FTEs, well, I spent a lot of time talking to people about look through why people left. Why are people at a lower amount of hours? Because if they fit in the right categories, you're still going to count them as a full employee potentially. So if someone dropped their hours and you said, because say you had someone in your restaurant that was closed, so you let the staff go, they claimed unemployment, that's fine. And now you're saying, okay, we can come back. I really need you to come back. And they said, I don't want to come back for whatever reason. And if the employee says, I don't want to come back, you get to count that as a FTE. You get to count that employee in essence as if they're hired. If someone's fired for cause, and that you get to count that person. If somebody voluntarily resigned, you get to count that person. Employees who requested and received a reduction in their hours, you get to count that as at the level they were before. And I think we all have seen a lot of this where people have with the closing of the schools, where more people were working from home and taking time off to help their kids with their schoolwork. And to do that, they needed time off of work. And so if you look through, I bet you have a lot of those type people in your employee base. So if you're close on these FTEs with some of your testing where you might not pass, you take a closer look. I bet you a lot of these exemptions will actually apply to you. This, the FTE Safe Harbor here, they've got them noted here. This is basically the same one we had in the past. It's just, they're just going back to December, okay? And they're making it clear, you look at the FTEs at the early of December or the date the application is submitted. So this particular safe harbor, you have to look at what are your FTEs between February 15th and April 26th. That's 30 days after the law was signed, if you wonder where they came up with April 26th. And you use that number. You compare back to February 15th. If February 15th is greater than this, then as long as when you submit your application or December 31st, whichever is earlier, if you can get this number to equal or exceed February's number, you meet your FTE safe harbor. You won't be harmed by that. If February 15th is less than this average here, this safe harbor is not available. All right, this is I promise you this is the most words I have on a slide, but it's the newest safe harbor. It's right from it's a big part of the flexibility. And I just want to put all the words in there, but realistically, if you look at it, it's saying that if you can't get up to the same level of employees as you were because you've been prohibited from doing so because of everything that's going on right now. You know, between the CDC and OSHA, they're saying you have to maintain the standards of sanitation, social distancing, and other safety requirements. Where you can't get to those levels, you are just deemed okay. So once you've spent the money, you will be fine, okay? But remember, they're comparing back to the end of the covered period, okay? So for the people that are really impacted between February 15th and the end of the covered period, it just says spend your dollars. Once you've spent your dollars in an appropriate manner, then you can apply and you don't have to worry about the full-time equivalent tests. In our people that are earning less than $100,000, if they've had their salary reduced by more than 25%, then we have to take a reduction in the eligible payroll that we're using. And it's not for the amount between, so if someone made $100, if their wage is cut to $80, it's not an issue. If it's cut to 70, it is. You have to make an adjustment for that $5 they didn't get over that as an annualized amount for the proper period of time. Sounds simple, but when you get into the details, it's a little more complicated. So there is a safe harbor if people's wages get back to where they were by the end of December of 2020. So there are some options. So rather than go through the full calculation, just know that because most people really, they either have reduced people's wages and they're coming back, or actually they get to the point where they're just reducing overall headcount now. So it's not really going to be a change in wage issue. But if you need help with these salary reduction steps, be happy to walk through it with you at a separate time. So I want to make sure I can get to everyone's questions here. Just keep in mind too that you're not double counted against. So if you're a salaried worker, it's pretty straightforward to see whether there's a reduction in pay. If you're an hourly worker, you got to watch, because you don't want to be, if you reduce someone's hours, you reduce FTEs, and if you reduce their hours, you're also impacting their wage amount. So you just want to make sure that you're not double counting those reductions, okay? I love it when they put an optional reporting form in any application. I'm sure all of you will be rushing to try and figure out exactly getting everybody lined up for who really is a principal. And yeah, right. I have not had one question on who really is a principal and filling this out, because that last sentence, and is the most important sentence when you look at it. Disclosure is voluntary and will have no bearing on the loan forgiveness decision. So I'm really not expecting a big rush on that, but I think that's the most important sentence on there, is don't worry about it. I know I'm not planning on filling it out on our form. There is an EZ form. That's right. So instead of making the law simpler, let's just make a form that makes it look simpler. So what the EZ form is just like in the tax return, where we used to have a 1040 EZ. And the 1040 EZ didn't get you to a lower tax. It didn't reduce the amount of work. What it did do is it reduced the number of lines on the form, and meant so you didn't have to put a whole bunch of zeros on it. This EZ form really has the same process. You're going to get together the same type stuff. It's just that to use this form, you're saying I fit in a bunch of the safe harbors. I'm going to I don't have a reduction in wages. I don't have a reduction in employees. So it just means you don't have to fill out some of the other schedules, because they really won't impact you. So on the new short form, certifications are similar. The new section really is this in addition part here. You have to certify that you're meeting some of the safe harbors, or that your employment's remained consistent. So it's not really an issue. There is, so just like with the old, the 1040 EZ we used to have, you just mark which of these three, you have to be able to say that you fit in this group, these groups, or you can't use the form. One is, like we talked, you're self-employed, you had no employees, and if that's all you've got, they know, okay, guaranteed you will pass. Just mark the box. Next one is you didn't reduce any salary or wages. So you're fine there. And you didn't reduce the number of overall employees. Or you didn't reduce a lot of the wages, and you fit within the COVID exception that you could get up to full staffing levels. due to COVID issues. So keep in mind, it's just fewer schedules, but no difference in your calculations. You have to file for forgiveness within 10 months after the end of the covered period, because remember, you have to begin paying within 10 months. Within a year after covered period, bankers get 60 days to decide if you have forgiveness. So that's why it has to be within 10, so that you get up to 12, including the time to make the decision on should you have your loan forgiven or not. Otherwise, you just have to begin making payments on the loan. Now this, kind of follow me through here. Big question I'm getting is, can I file for forgiveness as soon as I have spent the funds? Well, if you read the latest documents from the SBA, in English, they say, yes, you can apply for forgiveness as soon as if you had used the funds, even though it's before the end of the covered period. It says it right there. But we're going to need guidance on how to make that happen, because all the FTE calculations, with the exception of one that I could figure out, all the FTE calculations are based upon the covered period. So how can you do your FTE calculation until the covered period is done? And we're hoping they're just going to come and say, well, do your testing through the last payroll that you're using for expenditures. That's probably what they'll do. It's my guess what they'll do, but they haven't done it yet. So until they do that, just you're going to hang tight, frankly. Just hang tight, because right now you can't really complete the form unless you're going to use the exception of your FTEs dropped from February to April 26th in comparison to February 15th, because you're allowed then to compare to either December 31st or the earlier day of when you applied for forgiveness. So that, if you foot in that one, yes, you can complete everything. But without that, you have to wait till your period is over. And that's, just keep that in mind. Now we're going to do a little math, but I think it'll help lay out why many people will really want to wait. So I just, this is not any client example, it's just math that I made up just for this purpose. So say you had 5 employees, one of which is an owner, and in 2019, everybody makes $1,000 a week. Everybody has health insurance of $1,000 a month, and we did a 3% profit sharing. Rent and utilities are $7,000 a month. But back in on St. Patrick's Day, you let 2 people go, you stop your profit sharing and reduce everybody's wages 20%. Let's just see how things would work. So first is the amount of the loan. So the amount of the loan is based upon your 2019 payroll. So your monthly wages would be, for everybody, be $21,667. Health insurance would be $5,000 for a month. Profit share would be $1,000. And so if my profit sharing was $1,000, it'd be $27,000 loan. Monthly amount multiplier would be 2.5 months, gets me to $69,000 $69,000 loan that I would have applied for. Now, the amount spent in the 8-week period. So now I'm only going to look at 3 people's wages because everyone was let go on St. Patrick's Day, and the 2 people were. And I reduced everybody's wage from $1,000 a week to $800 a week. So I have wages, my health insurance benefits are there. There's no profit sharing because there's cost cutting, we got rid of it. So my total payroll amount is $25,200. I don't have to worry about I didn't make the modification here in the 24 weeks for, I do have a little too much of my owner payroll. There's a little tweak in there, but I didn't want to get too nerdy with the math. So I just let that be. Yes, there would be a small modification for that. My non-payroll amounts, I just did 2 months for the 8-week period, and I did 5 months for the 24-week period. Potentially be a little different depending upon when you make payments. My FTEs are a 0.6. I had 5 people in January and February, and I only have 3 people now. So when I add up all my costs, since I only have 60% of the employees, I have to I didn't keep my employment up, then I'm only allowed 60% of my costs in both cases. And here's my loan I applied for. In an 8-week forgiveness, I only get about 1/3 of the loan forgiven in this scenario. Whereas in a 24-week period, I get everything forgiven. So even though I had a 20% reduction in pay, even though I have a 40% reduction in my staff, I still can get to 100% forgiveness by using the 24 weeks. Now that's really what the story of this example is that the 24 weeks is really saying we want everybody to have their loan forgiven. PPP borrowers will be published. That's some new, that just came out here recently. So they're going to disclose names, addresses, industry codes, zip codes, business name, business type, demographic data, and loan amounts in ranges. So they're not going to say exactly how much you got, but they will say where you fit in those ranges. If loans are less than below, I said the word before should be below, those are just going to aggregate in totals, and they're going to put it together by all those other things like zip code, industry, and business type. More changes could be near. I was fully expecting the way these preparation for these seminars have gone. This is the 5th iteration we've done of this. The SBA generally issues new rules within 48 hours of me issuing the seminar. So I was fully expecting new rules to come out last night, but at least as of noon today, nothing new had come out that I saw. So they've been sitting on a lot of these new changes. Originally, we thought they were holding it because they were expecting forgiveness to pass, flexibility to pass, and it did. But they still haven't issued more FAQs. So I expect a lot to be issued very soon. The tax issues related to forgiveness, that still could change. The slide hasn't changed except for just a reminder that the loan itself is what is forgiven. It's not, getting the loan is not taxable. Forgiving the loan is not taxable. It's right in the statute. But the statute does not say you can deduct the expenses. And because that can since there's already Internal Revenue Code 265, which says that expenses allocated to tax-exempt income are not deductible without a congressional change, you cannot deduct the expenses that are attributable to forgiveness. Furthermore, could there be another round of loans? Remember, I kept saying there's only one loan, one time, one bite at the apple for that. Well, like everything in this whole process, things are changing. So the total funding between rounds 1 and 2, you know, $349 billion and $310 billion, is $659 billion. As of June 24th, there were $517 billion of approved loans for 4.7 million borrowers. In the last 30 days, there's been only about $4 billion in new loans. There's still over $100 billion left. At that pace, it looks like most everyone that wants a loan has already gotten a loan. So, as such, there's a new proposal to allocate the unused funds to small businesses that have been harmed, and basically taking the dollars that were already allocated and repurpose them. And then what they would do is have people apply for additional funds. There's a lot going back and forth about what could or could not happen. But watch for that. There's some traction growing in this area. But it's politics. We never know what really will happen. But hopefully some good things will happen. So now I'd like to do is just, there's a few questions here. I'd like to make sure we can get through those questions as best we can here. And then if anyone has anything else, just let me know. We'll kind of go through there. So right now, a couple of the first questions are talking about the flexibility period as a choice, one or the other. Once they get the forms designed, the guidance updated, you can pick, it doesn't have to be, it could be 8, you could pick 9, 10, 11, 12, whatever you want, just as long as it's no more than 12. So what you're going to do is on your FTE counts, you're going to look at, if you come back to full people, to full employment, basically compared to February 15th, we can work back. You can get full forgiveness, so that's kind of a nice deal. Also, remember there's the other FTEs for options for COVID issues, because I know who wrote this question. So the question, what do you need to keep regarding PPP for tax prep for 20 taxes? Nice to think that even though we're still wrapping up 2019, we still got a plan for 2020. So really want to compliment Kathy for already thinking ahead. So there's a few things we're already thinking about, and that'll be a topic of a future seminar. Realistically, the biggest thing is going to be your application form. Your application form is going to lay out the different expenditures. Gut feel is we're going to have to allocate the expenditures to offset against the amount of forgiveness. And there's some quirks with sole proprietors and partnerships, so that they'll have to get more data out on. But just for right now, just keep your books like normal. Make sure we have your information for what you applied for forgiveness, and then we can help put it together. Someone was asking about corps with a 6/30 year end, or maybe like an accounting partnership with a 6/30 year end. So what we're doing right now in that situation is we're hanging tight for right now. My particular thought, and there's no guidance yet, I've tried to elevate it a little bit at the IRS, is just like with the parallel under 265 for non-deductible expenses because the income would be tax exempt. I think we have to look at when the period of the expenditures were made is going to be how we're going to have to allocate. That's why I think it's going to come down. So I have a June 30th year end. I'm most likely, so most of my expenditures for forgiveness will fit within the June 30th time period. And even though my forgiveness really isn't going to happen till the following tax year, since my expenditures happen now, I think I have to reduce my expenditures now and worry about the forgiveness later. But again, we're going to see what, we're going to hold tight for a little while just to see what happens. Any allowance for locations closed, we've had some discussions about there were people selling businesses or whatnot. Actually, we are, the way we're working with that is that might be a reason to use, yeah, we'll have to balance out the option between using 8-week forgiveness and 24-week forgiveness. There's a penny upon the magnitude of the closing. That might be, that's a tough one, but there's nothing in the rules right now. So the just kind of going through to see why would someone choose the 8-week period? Probably possibly because of FTE counts. There's a couple reasons. That's one of the reasons we're looking at it here is FTE counts. The other reason, selfishly why I want to do it, I want to get ahead of the curve. So if I get my application a little earlier, I can tell people we've done it, here's what works. So be a better advisor. The other reason is, like mentioned about some of these split years, that makes it clear what year the expenditures fit in. Sometimes it has to do with your banking, depending on the timing of getting your financial statement to your banker, because if we get so there's staggered dates where we could turn in these applications, I think it's great for everybody. If the SBA says, oh, wait a minute, we forgot about the FTE issue, those calculations have to be through the covered period, then everybody's going to be applying next October, November. And I don't know how physically they could get through everything in 60 days. It would be the application fiasco would be a forgiveness fiasco. So I think they'll find a way to get us to do overtime. And overtime, then it's not as critical, 8 or 12 or whatever you need. The question is, how do you deal with employees making over 100 grand now? I don't think they're still going to be. They're going to be limited. The way that you're going to be handled that is they're going to be limited on their employment, on the total employee compensation that's been allowed. They'll still be listed in Table 1. Now for C Corps, if is a shareholder an employer, are they an owner employee? Yes, they are. If you're related to a 2% owner, are you an owner? I took that slide out of the because I tried to keep the numbers down, but as I'm reading everything, there's nothing. The attribution rules for are more of a tax issue than a banking issue. So I'm only looking at direct ownership. If you have a very small loan, do you need to apply for forgiveness? So if you got one of the grants, you know, the EIDL grants, then you don't have to apply for forgiveness. But if you got a small PPP loan, yes, you should apply for the forgiveness, because otherwise that loan's sitting out there. When is the expenditure made? The expenditure made I've not been saying the check has to be cashed. You just have to issue everything within the payroll period, the appropriate period. So if we're looking at Schedule C owners, you're always going to look to 2019. So if 2019 is a good year, that's how you base your loan, and that's really for the payroll substitute. You're always going to look to 2019. So if 2020 is awesome or awful, is immaterial for at least the earnings for that the owner. There is still talk about making deduction with PPP deductible. I haven't seen as much traction for that as seeing traction for the expanding the program for businesses that were really harmed. The dates are dates, just so you know too. So that's why I put in the one example. You look at Sundays. I mean, you don't. It's not. And because you're looking at Sundays, you have to look at the exact days. So that's when. If you have a payroll you normally do on a Monday and you want that in the prior period, then pay it the prior Friday. We're moving one of our payrolls up. It should normally be July 1st. We're going to do it on June 30th. And then we talked about the COVID exception. So the question is on the payroll periods. Can you have multiple boxes checked? I believe you can. There's nothing that says you can't. It just says what are your payroll periods. It doesn't say what is the majority. It doesn't say what is. It just says what do you use. So I would have multiple boxes marked if I had both biweekly and monthly payments. And you want to look at for furloughed people, you really want to look at the days that are there, on whether on the 8 or 24 weeks, again, on where your employees are furloughed or not. I think you're really going to look at, you're allowed to just calculate best ways. See, Carl, who works at the AICPA, saying Treasury still tells us there's about 30 FAQs coming out. That's great. Hopefully they'll come out sooner than later. Yeah, what happens if I know of fortunately I did not help with this application at all, where someone they put in their payroll amount, they included their rent, they included independent contractors, they included all kinds of crap they shouldn't have, and their banker let it go through because the banker was tired, I guess. So let's basically, a person like that just may be a win, because the loan, once the loan is going through, I have nobody knowing that's going back and seeing if they're right, especially if they're not in that under $2 million threshold. The one I was talking about is way under that amount. It was just laughable what really happened. So if for COVID reasons you couldn't open, yeah, if you had like a restaurant down to takeout only, because that's first you're shut down fully and then you're kind of coming back, but you can't come back full. That's exactly what that COVID exception is going after. Let's see. Carl's got a follow up because Carl, thank you, Carl, for sharing. Carl's saying there's some consideration to pass a bill to allow for deductibility. If it happens, it probably will not be till August or November or not at all. I think that's very fair, but thank you for your insight. I appreciate that. Yeah, about timing of the deductions where in 1 year, your deductions are 1 year, and the forgiveness is in another. Is there an advantage using 8 weeks in case new money opens up? Well, if we're going to allow if the SBA gets this FTE issue freed up, maybe we can use some alternate periods, but if that doesn't happen, there might be an advantage to this 8 weeks because of the potential new money use that they're talking about. You have to have used all the funds first, all the PPP funds that you had before. Let's see. Is there any talk about blanket forgiveness for PPP loans under 150,000? That was one of the options they talked about. And right now, I have not seen anything on that. I haven't heard anything on that as far as an issue. But on that, I've made it through the loans the questions that everyone has had here. But as always, we're around. We've been around for 95 years, so I think we'll be around to answer your questions here for a while. So feel free to always reach out. We're doing our best to stay up on top of this ever-evolving issue. Thank you for your patience, and have a great day. Thanks a lot.